If you currently have a loan with Mr. Cooper, there may be thousands of dollars in incentives available for you to refinance right now. Would you refinance if it cost you nothing and lowered your monthly payment? Well, for most people, the answer is yes. So in today's video, we're going to discuss why right now might be the smartest time to refinance, especially if you have a Mr. Cooper loan. Now, before we dive into that, I want to take a minute here and just talk about interest rates over the last couple of weeks. We've seen mortgage rates move from over 7% to the lowest level that we've seen all year, which depending on who you were following was just under 6.5%. And the reason you're seeing mortgage rates move so quickly is because there's a lot of volatility out there in the market. In fact, if you want to see mortgage rates move down, then that likely means you want to see a slower economy. You want to see a weaker economy. In fact, you want to see the stock market do poorly because when money comes out of the stock market, it typically flows into bonds, which in turn causes the 10-year to move down, which typically means mortgage rates follow. And if you've been paying attention to the news at all, then you likely know this is going to be a bumpy road. 2025 is going to be filled with a lot of volatility, which means mortgage rates aren't likely to move down in a straight line. And the reason I say this is because refinance windows could be short, which means you need to make decisions based on financial strategy and not trying to time the market perfectly. And that's one reason my lending team created a refinance watch list so that you could go in and enter your information and allow them to watch interest rates for you so that when interest rates hit the level that you've been looking for, they can just reach out to you and say, hey, interest rates are here. Would you like to take advantage of it now? Because the flip side is you're watching interest rates every day, likely having no idea what you're looking at, but also getting caught up in all the crazy headlines. So if you'd like to stay away from that and let my team watch interest rates for you, do me a favor and check that link in the description. So just a couple of weeks ago, Rocket announced a $9.4 billion acquisition of Mr. Cooper, making them the largest mortgage servicer in the United States, which in turn means they're going to be servicing $2.1 trillion in mortgages. Now, if you're watching this going, why would Rocket acquire Mr. Cooper and why does it matter? Well, the answer is really simple. Rocket will now control 1 in 6 mortgages, which means not only do they have the largest share of servicing rights, they also control the largest share of the market, which in turn means any time one of these loans has to refinance, Rocket is likely to get that business, which in turn means more money in their pockets, but at the same time, less competition, which means they likely don't have to be as competitive on rate. They likely don't have to be as competitive on fees, which means Rocket's business continues to grow while the consumer likely isn't getting the best deal in the market. And that's why UWM, which is United Wholesale Mortgage, is responding super aggressively, is launching a program by giving brokers 100 basis points in incentives to refinance Mr. Cooper loans back into UWM. Now, if you're wondering again why this matters, UWM is just available to brokers. You can't go out and directly get a loan from UWM. There's no retail. So the only way to get a loan from UWM is that you have to use a broker. And one of the biggest incentives of using a broker is that a broker can shop your loan around to multiple places. So depending on your scenario, that broker can shop your loan to make sure you're getting the best rate and fees. Whereas if you just go to a Rocket or you just walk into your bank, you're only given the programs that they have. You're only given the rates that they're offering. Whereas on some days, maybe Rocket's not the most competitive out there. And so in those cases, a broker can shop your loan so that you can take advantage of the best rate, which in turn means a better monthly payment. And the really cool thing about this is a huge opportunity out there for borrowers. Now, at the moment, they're only giving this 100 basis points in incentives to loans that a broker has currently put into Mr. Cooper. So if I did your loan and your loan got sold to Mr. Cooper, then UWM will give me 100 basis points in incentives, which typically works out to about 0.25% in interest rate to go out and try to get you to refinance back into UWM out of that Mr. Cooper loan. But here's what's really cool. My inside scoop is telling me that they're going to allow this to all Mr. Cooper loans really soon, which means if your loan is currently being serviced by Mr. Cooper, right now might be the best time to start comparing your options. So with that said, if you've been considering refinancing, you're thinking about refinancing, you want to work with a professional, our team, you have a Mr. Cooper loan, you don't have a Mr. Cooper loan, but you want to work with somebody with competitive rates and fees, well, do me a favor and use that link in the description. You can speak directly with my team and get help just like the hundreds of people that we've helped here on YouTube. But with that said, it's not always a great time to refinance, and that's exactly what I'm going to talk about right now. I want to talk about refinance traps to avoid, along with when it makes sense to actually refinance and the idea of paying points when you're doing it. So the first trap I want you to avoid when talking about refinance is this idea that when you do a loan with somebody that they offered you this no cost free refinance if you go back to them. If anyone is offering you a free refinance, understand it's a marketing tactic. It's a gimmick to get you to go back directly to them and not check rates with other brokers, other banks, etc. In fact, if your lender is telling you that they're giving you a free refinance option, my advice to you is to run. Because chances are, if they're offering you a legit free refinance, then that means you're not getting the best interest rate out there. You're not getting charged the best fees, because the only way to do a true free refinance is by charging you a higher rate to cover the fees that are associated with that loan. Understand that every single loan, regardless of whether it's a purchase or a refinance, have title and escrow fees, along with different lender fees. So the only way to cover those fees for it to be a true refinance is to either charge you more in interest rate to make up for those costs, but sometimes they're sneaky and they just roll it into your loan amount. So say you went into that refinance with a $500,000 balance on your mortgage, and let's say you have an interest rate of 7%. So on top of that, maybe they're saying they're going to give you a 6.75% interest rate, and there's not going to be any fees associated with that loan. Well, guess what? Today's interest rates are somewhere around 6.5%, which means they're already giving you a 0.25% higher. And on top of that, they're likely raising your loan balance. So instead of refinancing the $500,000 balance you came in with, they're probably raising your loan amount to $503,000, $505,000, even $510,000 to help cover the cost that they're charging you to do your loan. So please understand, there's no such thing as a free refinance. Now, there is something called a no-cost refinance, which is essentially the same thing, but that's where a lender is being transparent with you. They're telling you, hey, listen, there are no fees associated with that loan, but the way I'm able to do this is we're charging you a slightly higher interest rate to help offset those costs. Now, if you've watched any of my videos before, I actually did 2 no-cost refinances back in 2024. I took my interest rate from 7% all the way down to 6% on 2 different occasions. The first one was 7% down to 6.5%, and the second one was from 6.5% down to 6%. Now, understand, neither of those times did I pay closing costs. I took a slightly higher interest rate on both of those occasions, which gave enough yield spread from the lender to cover my costs. And the reason I did this is because I didn't want to have a sunk cost when it came to refinancing. And because I believe interest rates are going to continue to trend lower, I don't want a sunk cost. I want to be able to take advantage of interest rates as they present themselves, as it makes sense. I don't want to second guess it because I paid money to buy down the rate or paid all of these fees, whether or not it makes sense. On top of that, another way a lender might make a refinance look a lot better than it actually is by resetting your loan term. Understand, when you originally got your loan, you probably got a 30-year fixed mortgage. Depending on how long you've had that mortgage, you've been paying down the time on that loan. So for example, if you've had that loan for 2 years, you only owe 28 years left on that mortgage. Well, what a lot of lenders will do is they'll reset that term back to 30 years, in addition to lowering your interest rate where it looks like the savings are way better than they actually are. But understand, you've just reset your loan back to the original term, which means you're no closer to paying off that loan than you were 2 years ago. So when you're going through that refinancing process, just make sure you're having that conversation with your lender. Make sure that they're explaining all of this information to you. If they're resetting your loan back to 30 years, they should be telling you that, because all lenders have the ability to set the term to exactly where you were in that process. But unfortunately, most lenders won't tell you that because it will impact the amount of money you're actually saving. Now, at the end of the day, if you want to reset back to 30 years, then that's on you, but it should be your choice. So the question is, when does it actually make sense to refinance? Well, my lender has this formula that he's been using for years, and it's something that we've passed along to a lot of people out there to help them determine whether or not it makes sense. And the idea is that you take $125,000 and you divide it by your loan amount. So in the case that you owe $125,000 on your mortgage and you divide it by $125,000, that means you need to save 1% on your mortgage rate for it to make sense. Whereas if you had a loan balance of $250,000, you need to save 0.5%. If you have a loan balance of $500,000, you need to save 0.25%. If your balance is $1 million, you need to save about 1/8% on your loan in order for it to make sense. But even then, that doesn't mean it always makes sense. That's a general rule. You then need to factor in the savings that you're getting by lowering your interest rate by that much, and you need to divide it into the cost that they're charging you in order to do that refinance. So let's say, for example, you're saving $83 a month by refinancing, but it's costing you $5,000 in order to do that refinance because you didn't get a no-cost option. You took the best interest rate out there in the market. Well, if you divide $5,000 by $83, that means you need to have that loan at least 60 months in order to break even. So in the case that you plan on refinancing if mortgage rates move lower and you think that's going to happen in the next 1 to 2 years, 3 years in some cases, or in some cases, maybe you plan on selling in 1 to 2 years because you're not going to have that home. You're going to move somewhere else. Well, in that case, then it probably doesn't make sense to refinance. But in the case that you're able to get a no-cost refinance like I did, I was able to lower my payment $400 each time I refinanced, and it cost me no money out of pocket. So for me, it was a no-brainer. I have no sunk cost in the mortgage. If mortgage rates move lower, I can take advantage of them. If mortgage rates move higher, then I'm stuck at my rate. I'm at a good rate. I don't really care. But the best part is I paid no money in order to do that refinance. So before you run out, sign a bunch of paperwork, and just decide to move forward with a refinance, just make sure you're calculating your break-even point. Now, when it comes to paying points, I get this question a lot. Should I pay points when doing my mortgage? And the easy answer for me is no, at least 99% of the time. I don't think in this market you should be paying points because I think there's a chance that mortgage rates continue to move lower. In fact, I believe that mortgage rates are going to continue to trend lower. Now, with that said, the reason I say that you shouldn't be paying points is because points are a sunk cost. And if you could get that rate in a month, 6 months, a year from now without paying the money to refinance, would you have paid it to start with? And the answer for most people is no. If you knew you could get that rate in the future without paying for it, then you probably shouldn't pay points for that rate now. Because the reality is paying points for most people doesn't make sense unless you're going to keep that same loan for more than 5 to 7 years. It's because of that calculation that we did just a moment ago. By paying 1% in discount points, that's 1% of your loan amount. So in the example that you have a $500,000 loan balance, you're going to pay $5,000 in order to get a quarter savings on your loan. So in the case that you have a $500,000 loan and interest rates are at 6.75%, then that would mean your mortgage payment would be $3,242 a month. But in the case that you decided to pay points, you'd pay around $5,000, which is 1%, in order to get a 0.25% lower rate. So in this case, you would get a 6.5% interest rate, which would give you a payment of $3,160, which means you would be saving about $81.66 per month. Now, for some, that might sound like a huge savings, but when you realize it takes you over 61 months, which is over 5 years, in order to recoup that cost, most people would choose to keep the money in the bank versus having a $81 lower payment. So in my opinion, you shouldn't be paying points unless you're one of the 1%. And the 1% that I think about in this scenario is somebody that's maybe retiring, somebody that's not going to have a job in the future and going to be able to refinance. They're not going to be able to qualify for a loan in the future, so they want to get the best available rate to them today. Then in that case, it could make sense to refinance. And part of the other 1% is those people that don't think mortgage rates are going to move lower. They think rates are going to go higher from here, and you just want to get the best rate out there in the market. Then in that case, it could make sense. But for me, I think mortgage rates are going to move lower, so paying discount points right now is not something you should consider. But with that said, just make sure you're working with a professional, somebody that can walk you through this process, somebody that's giving you options. Not only should they be showing you different loan programs, maybe in some cases you're getting out of an FHA loan into a conventional loan. They should be showing you both options in that scenario because you can do an FHA streamline, but you can also get into a conventional loan and maybe get rid of mortgage insurance. On top of that, if you're somebody that wants the absolute best rate in the market, then they should be showing you an option with the best rate in the market, but maybe they're showing you a slightly higher option as well so that you're not paying any points. Either way, they're advising you. They're not telling you what you should do. They're giving you options and letting you make the best decision for yourself. Now, if you're watching this and you want to work with my team of professionals, do me a favor and check that link in the description. Now, my advice for anybody that's considering refinance is do it when it makes sense. Stop trying to pick the absolute bottom in rates. As we said, interest rates are likely going to be volatile. They're going to move up, they're going to move down, so it's going to be very, very difficult to catch the bottom every single time. Just do it as it makes sense and try to do it with a no-cost option so that as interest rates move down, you can take advantage of them every single time. In addition to that, I would start gathering paperwork now. Start having that conversation with a mortgage professional now, especially if you're with Mr. Cooper, because I do believe there's going to be a refinancing opportunity really, really soon, which I discuss in this video right here.